The amateur trader is obsessed with the perfect entry. He will spend 99% of his time, his energy, and his intellectual capital searching for that one elusive signal that tells him when to buy. He believes, mistakenly, that the entire game of speculation is won or lost at the point of entry. The professional, by contrast, is obsessed with the perfect exit. He understands a truth that is fundamental to the very nature of the market. A paper profit is a fleeting, theoretical, and ultimately meaningless thing until it has been successfully converted into cold, hard cash. To make this conversion, especially at a market top, you require something that is often in very short supply: a willing buyer, someone who is eager to take the shares off your hands at the very peak of the price. Richard Wyckoff dedicated his life to studying how the largest and most astute operators in the market solve this most fundamental of problems. How does one sell a position of 100,000, 500,000, or even 1,000,000 shares of a stock without the very act of selling causing the price to collapse, thereby destroying the very profit one is attempting to realize? The answer, he discovered, was as profound as it was simple. The great operators do not search for an exit, they create it. This is the story of how they do it. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. To comprehend the art of the perfect exit, we must first grasp the fundamental and immense problem faced by the large operator, the entity Richard Wyckoff personified as the composite operator. A small retail trader operates with a degree of nimbleness that the great operator can only envy. If a retail trader wishes to sell his 100 shares, he can do so with a single click of a button, his order absorbed by the market's daily flow with barely a ripple. His decision to sell is a simple, tactical one. For the composite operator, the decision to sell is not tactical, it is strategic. It is the beginning of a long, complex, and perilous military-style campaign that must be planned with the utmost care and executed with flawless precision. His problem is one of sheer scale. He may have spent months in a long campaign of accumulation, quietly absorbing a vast line of stock at low prices. Now, after the price has enjoyed a substantial advance, his holdings represent an enormous paper fortune. But this fortune is a prisoner. If he were to enter an order to sell his entire position on the open market, the sudden and overwhelming wave of supply would instantly shatter the delicate balance of the market. The price would collapse in moments, plunging 20, 30, or even 50% as his own selling begets more panic selling. In such a scenario, he would be the primary cause of his own ruin, his magnificent paper profit evaporating into a catastrophic loss. Therefore, the central overriding objective of the composite operator at a market top is the cultivation of what is known as exit liquidity. Liquidity in this context is more than just the presence of a few buyers. It is the presence of a vast, deep, and emotionally charged pool of willing and ideally price-insensitive buyers. He needs to find a crowd, a great multitude of traders and investors who are so consumed by optimism and greed that they are willing to absorb every last share he has to sell, and to do so at the highest possible prices. This crowd of euphoric buyers is his exit. They are the essential ingredient without which his entire campaign of accumulation and markup would be for naught. Without them, his profits remain trapped, a theoretical fortune held hostage by the mechanics of the market itself. The entire process of engineering a perfect exit, therefore, is the process of first creating this crowd and then methodically and discreetly selling to it. This brings us to the second and most crucial part of our analysis, the creation of the necessary euphoria. The composite operator understands human psychology better than any university professor. He knows that a great crowd of eager buyers does not simply appear out of nowhere. It must be cultivated, nurtured, and brought to a fever pitch at the precise moment he is ready to begin his distribution. The single greatest tool he has for achieving this is the very uptrend that precedes the market top. The markup phase, as Wyckoff termed it, is not just a period of rising prices, it is a masterful marketing campaign, designed and managed with the ultimate objective of building the exit liquidity he will require at its conclusion. Let us trace the psychological journey of the public as this marketing campaign unfolds. In the early stages of the markup, just as the stock is emerging from its long base of accumulation, the public is largely absent. They are either still fearful from the prior decline or are deeply skeptical of the new advance. The news surrounding the company is often still mixed or negative. The first rallies are dismissed as temporary, as a sucker's rally, and the composite operator is able to push the price higher with relative ease, as there is little public participation and therefore little supply to overcome. As the trend progresses and enters its middle stages, a mood of cautious optimism begins to take hold. The price has now advanced significantly from its lows, and the trend is becoming more obvious. The more astute members of the public, along with some professional trend followers, begin to participate. The stories of the early buyers who have made substantial profits begin to circulate, planting the first seeds of envy and greed in the minds of those who have remained on the sidelines. The news flow begins to turn positive. It is in the final third stage of the markup that the composite operator's marketing campaign reaches its crescendo. The price advance, which may have been orderly and gradual, now often accelerates, becoming steeper and more dramatic. The public, which had been hesitant, is now overwhelmed by a single powerful emotion: the fear of missing out. All skepticism is abandoned. The steady drumbeat of rising prices and positive news creates a feedback loop of pure, unadulterated euphoria. It is at this stage that the stock becomes a topic of widespread conversation. It is featured in financial news programs, celebrated in magazines, and touted by analysts who issue ever higher price targets to justify the already extended valuation. The composite operator understands that the public needs a narrative, a story to tell themselves that justifies the reckless act of buying a stock after it has already quintupled in price. The glowing news articles, the promises of a new technology, the spectacular earnings reports, all of this becomes the logical pretext for the public's emotional decision. In the final terminal phase of the advance, the composite operator may engage in the deliberate act of marking up the price to a final parabolic peak. He may become an aggressive buyer for a short period, pushing the price up in a near vertical ascent. The purpose of this final spectacular move is twofold. First, it is designed to create a state of absolute frenzy, to trigger the final capitulatory wave of buying from anyone who was still holding out. It is a show of ultimate strength designed to shatter the last remnants of doubt. Second, it creates a vital price cushion. By pushing the price to an extreme peak, far above his own average cost, he gives himself a wide and comfortable buffer zone in which to conduct his subsequent distribution. This final explosive rally is not a sign of a healthy and sustainable trend. It is the grand opening of the composite operator's distribution store, and the euphoric public, convinced they are buying into the beginning of a new paradigm, are lining up to be his best customers. And so, the stage is now perfectly set. The long and masterfully managed marketing campaign of the markup phase has reached its zenith. Public euphoria is at a fever pitch. The news is overwhelmingly positive, and a vast, deep, and emotionally charged crowd of eager buyers has been successfully gathered. The composite operator, the great and silent intelligence of the market, now stands before his ideal audience, holding an immense inventory of stock that he accumulated at a fraction of the current price. His task is now to begin his second great campaign, the methodical, discreet, and utterly ruthless process of selling every last share he owns to this euphoric public. He must now commence his subtle and deadly work. This brings us to the great paradox of distribution. The composite operator cannot simply begin to sell his shares in a continuous, unrelenting stream. To do so would be to reveal his hand instantly. An avalanche of supply would quickly overwhelm the available demand, and the price would collapse, scaring away the very crowd of buyers he has worked so long and hard to cultivate. He requires a structure, a carefully controlled environment that allows him to feed his immense supply into the market over a prolonged period without triggering a panic. This structure, this theater of operations for his campaign of distribution, is the trading range that forms at the market top. To the untrained eye of the public, the sideways price movement that follows a powerful advance is interpreted as a sign of health and strength. They have been taught to recognize patterns, and they see what they believe to be a bullish consolidation, a flag, or a pennant. They view this period of rest as a necessary and constructive pause before the next great surge to even higher prices. This fundamental and catastrophic misinterpretation of the market's action is the absolute key to the composite operator's success. He relies on the public's optimism and their pattern recognition biases to provide cover for his true activities. The illusion of consolidation encourages them to remain bullish, to hold on to their recently purchased shares, and most importantly, to buy the dips every time the price pulls back within the range. Each purchase they make, believing they are securing a bargain before the next advance, is a transaction that allows the composite operator to move one step closer to completing his perfect exit. The trading range, therefore, is not a resting place. It is a meticulously managed abattoir, where the hopes of the many are systematically converted into the cash profits of the few. Within this theater of deception, the composite operator employs a sophisticated toolkit of tactics designed to maximize his sales while maintaining the illusion of underlying strength. The first and most important of these tactics is the art of selling into strength. The composite operator understands that he must sell when the buying is at its most aggressive. The periodic rallies that punctuate the trading range, driven by the public's persistent optimism, are his prime opportunities. As the price rallies toward the upper boundary of the range, the public sees what they believe is the beginning of the long-awaited breakout. Their buying becomes more urgent, their fear of missing out reignited. It is into this wave of enthusiastic demand that the composite operator unleashes a torrent of his own supply. The definitive proof of this activity is found by applying Richard Wyckoff's great law of effort versus result. The rising tide of public buying on these rallies generates a significant increase in the volume of transactions. This volume is the effort. An amateur trader sees this high volume and reads it as a bullish confirmation. But the professional analyst studies the result. He observes that despite the tremendous effort being expended by the buyers, the price struggles to make any meaningful upward progress. The price bars may have narrow spreads, closing far from their highs. The rally may stall and churn for days, with an enormous amount of activity yielding little to no net advance. In its most telling form, the price may fail to even reach the high of the previous rally within the range. This divergence between the immense effort and the poor result is the unmistakable footprint of the composite operator at work. It is the market's own confession that a massive invisible wall of supply is meeting and absorbing every ounce of the public's buying power. This is not consolidation. This is active, aggressive, and large-scale distribution hidden in plain sight. The second tactic in the composite operator's toolkit is as ingenious as it is deceptive: the art of manufacturing support. In order to keep the public engaged and willing to continue buying, the composite operator cannot allow the price to fall too far or too fast. A sharp, sustained drop would shatter the illusion of consolidation and trigger the very panic he is trying to avoid. Therefore, as the price reacts downwards and approaches the lower boundary of the trading range, he will often switch from a seller to a strategic, temporary buyer. He will step into the market and provide just enough demand to absorb the selling pressure and stabilize the price. To the public, this defense of a support level appears to be a sign of great underlying strength. They see the price stop falling and begin to turn up, and they interpret it as evidence that strong hands are accumulating the stock, that the smart money is defending the price. This manufactured event gives them a renewed sense of confidence. It validates their bullish thesis and encourages them to once again buy the dip, believing they are acting in concert with the most powerful forces in the market. In reality, they are acting as the composite operator's pawns. The support he provides is not a sign of his intention to accumulate. It is a calculated marketing expense. He is willing to buy back a small number of shares at a lower price in order to maintain the confidence required to sell a much larger number of shares at a higher price on the very next rally. He creates the demand that he will then, in turn, use as his own exit liquidity. The third and final tactic is the most insidious, the ongoing managing of perceptions. The composite operator knows that the public trader does not operate in a vacuum. He is influenced by news, by analyst ratings, and by the general financial narrative. During the markup phase, the rising price was supported by an increasingly positive story. During the distribution phase, the composite operator relies on the persistence of this positive story to justify the high price level, even as the market's internal action deteriorates. It is a remarkable and consistent feature of market tops that they are almost always accompanied by the most spectacularly positive news. Just as the stock is beginning to show clear signs of effort versus result divergence, a major publication may release a glowing cover story about the company. Just as the rallies are beginning to form lower highs, a respected analyst may issue a bold, strong buy rating with a new, much higher price target. This positive news flow provides the crucial psychological justification for the public to ignore the increasingly bearish evidence on the price chart. They see the price struggling, but they read the headline and conclude that the stock is merely pausing before its next great leap. This external validation overrides their own better judgment. The composite operator does not create this news, but he is a master of understanding its effect on the public psyche, and he times his selling campaign to take full advantage of it. He sells into the good news, using the public's faith in the narrative as the final layer of cover for his operations. Wyckoff's genius was his ability to read these internal market dynamics, the secret war between the composite operator and the public. His entire method is a masterclass in interpreting the tape. But we must understand that other market titans develop different yet equally powerful ways to solve the same problem, knowing when the party is over. Bernard Baruch, for example, was a master of mass psychology and fundamental conditions, famously saying he made his money by selling too soon. Nicholas Darvas ignored the news completely and used his mechanical box theory to detect when a stock's momentum was exhausted. Richard Dennis and his turtle traders used a pure trend-following breakout system. To give you a complete education in the art of the perfect exit, we created our new channel, Trading Insights. It explores the diverse strategies and philosophies of these legendary speculators. If you want to see this critical market problem solved from multiple angles, we invite you to subscribe and watch. The link is in the description. The composite operator, the great and silent general of the market, has now successfully executed the most arduous phase of his campaign. Through a masterful combination of psychological manipulation and tactical execution, he has managed to distribute the vast majority of his immense holdings to an eager and unsuspecting public, all while maintaining the price at a highly profitable plateau. The stage is now set for the final and most ruthless act of this financial drama. His work is nearly complete. All that remains is to dispose of the last, most difficult-to-sell tranches of his inventory, and to then deliberately and decisively initiate the new trend from which he also intends to profit. The time for subtlety and deception is drawing to a close, to be replaced by a final climactic maneuver of shocking audacity. This brings us to the culmination of his entire campaign, the fourth great tactic in his exit strategy, the engineering of the final trap. In the language of the Wyckoff method, this is most often the event known as the upthrust after distribution. This is the grand finale of the distribution campaign, a move of such cynical genius that it has served as the punctuation mark at the end of great bull markets for over a century. It is a sudden, sharp, and seemingly powerful surge in price that breaks above the established resistance of the trading range, creating a new high. It is designed to look for all the world like the resumption of the great bull market. But it is a lie. It is a hollow, fraudulent move, engineered with the singular purpose of ensnaring the last of the most optimistic buyers and triggering a final, fatal wave of the fear of missing out. To truly understand the power of this maneuver, we must place ourselves in the mind of the average trader at this precise moment. He has been watching the stock trade sideways for what feels like an eternity. His initial optimism has been eroded by the frustrating, choppy action. He is gripped by uncertainty. Then, suddenly, and without warning, the stock explodes to life. It surges upward with a power that has not been seen for months. It decisively breaks the ceiling that has capped every previous rally. The tape runs hot. The financial news commentators begin to speak of a confirmed breakout. At this moment, the trader is at his point of maximum emotional vulnerability. Every ounce of his discipline is overwhelmed by a single primal fear, the fear that he's about to be left behind. The trader who sold earlier is convinced he has made a historic blunder. The trader who has been waiting on the sidelines is terrified that this is his last fleeting chance to get in before the stock runs another 100 points. It is in this cauldron of intense, irrational emotion that the composite operator conducts his final and most profitable business. The anatomy of the upthrust after distribution reveals its fraudulent character. Its purpose is twofold. First, it is designed to attract that final, crucial wave of public buying, the very last dregs of the exit liquidity he needs to dispose of his remaining shares. Second, it is designed to deliberately trigger the stop-loss orders of any astute but premature short sellers who may have identified the distribution and acted too soon. Their buy-to-cover orders add fuel to the fire, amplifying the buying panic and allowing the composite operator to sell into an even greater frenzy. The definitive proof that this move is a sham lies not in the rally itself, but in its immediate aftermath. A genuine, professionally sponsored breakout would sustain its gains. It would hold above the breakout point, consolidate, and then continue its advance. The upthrust after distribution, by contrast, fails. It collapses back into the trading range with a speed and ferocity that is shocking to those who just bought into it. This rapid and total failure is the market's unambiguous confession that the entire move was a lie, a masterful illusion designed to facilitate the final act of the perfect exit. With the final trap having been sprung and the last of his shares now successfully distributed into the hands of the public, the composite operator's campaign reaches its final logical conclusion. His work is done. He no longer has any vested interest in maintaining the illusion of strength. He no longer needs to support the price. What happens next is both simple and devastating. He pulls the bid. The invisible floor that has been supporting the market throughout the long trading range vanishes. The strategic, intermittent buying that he used to manufacture support and maintain public confidence is simply withdrawn from the market. The price, which had been artificially held at an elevated level, is now left to the mercy of the natural laws of supply and demand. But the market is now in a critically weakened state. The composite operator has just spent months flooding it with supply, and this supply is now held by the weakest possible owners, the emotional, uninformed, and often over-leveraged public. When the artificial support is removed, the market begins to sag under its own immense weight. The first dip causes a flicker of concern. As the price falls further, this concern turns to fear. The public who bought at the very top are now facing losses, and their weak hands are shaken. They begin to sell, adding to the growing pressure. This selling begets more selling, and the decline accelerates. This is the moment of truth, the great sign of weakness that is the final confirmation of the market top. It is the breakdown below the trading range, and its character is one of shocking violence and ease. The price now falls with a speed and effortlessness that stands in stark contrast to the labored, difficult rallies that preceded it. The breakdown occurs on a wide, spreading price bar, and on a dramatic expansion of volume as the panic takes hold. It is here that we can observe the great and tragic contrast that is the essence of every market cycle. The composite operator's exit was a slow, deliberate, and calm process, conducted over months at the highest possible prices, into a climate of unbridled optimism and euphoria. The public's exit is a frantic, chaotic, and terrified scramble, conducted over a matter of days or weeks at the lowest possible prices, into a climate of abject fear and despair. The professional sold to the crowd at his leisure. The crowd is now forced to sell to the professional, who may well be starting his campaign of accumulation all over again at the bottom. How then does the astute retail trader, the student of the Wyckoff method, navigate this treacherous landscape? His objective is not, and can never be, to emulate the composite operator. He does not have the capital or the influence to manage a market. His objective is far simpler and far more elegant: to learn to recognize the footprints of the composite operator and to align his own actions accordingly. His reaction to the evidence is therefore threefold. First, the professional Wyckoff student uses the distribution to sell his own long positions. As he identifies the initial proofs of a top, the change of character, the buying climax, the effort versus result divergences, he does not wait for the final breakdown. He emulates the composite operator on a smaller scale, selling his shares into the strength of the rallies within the trading range, allowing the euphoric public to provide him with his own perfect exit. Second, and most importantly, he ceases to buy. Once the evidence of distribution becomes clear and compelling, he stands aside. He refuses to participate in the buy the dip mentality that is trapping the public. This single act of disciplined inaction is the most powerful tool for capital preservation in a topping market. Finally, the professional is patient in awaiting the short opportunity. He does not try to outsmart the market by shorting into the top, exposing himself to the risk of the final devastating upthrust after distribution. Instead, he waits with the cold patience of a predator. He waits for the entire story to unfold. He waits for the final breakdown, the definitive sign of weakness. And then he waits for the final low-risk entry point that the market almost always offers, the feeble, low-volume rally back to the point of breakdown, the last point of supply. It is only here, after all the evidence is in and all the proofs are on the table, that he finally acts, taking a short position with the confidence that comes from knowing he is trading in harmony with the market's true underlying trend. We have just walked through the composite operator's entire playbook for a perfect exit. But how does one develop the sharp judgment to see this intricate campaign unfolding in real time? Richard Wyckoff laid out the foundational principles in his essential work, How I Trade and Invest in Stocks and Bonds. This book is not a list of complex formulas. It is a guide to developing a professional mindset. In it, Wyckoff shares his own experiences and the core logic of judging the market by its own actions, the very skill required to detect the difference between genuine strength and masterful distribution. To learn how to read the story the market is telling you, you must go to the source. This book provides that timeless wisdom. The link is in the description. In our conclusion, we have seen that the perfect exit is not a single event, but a multi-stage, psychologically driven campaign. The composite operator does not find liquidity at the top. He creates it. He does this by masterfully cultivating a state of public euphoria, and then using that euphoria as the perfect cover under which to distribute his immense holdings. He operates within a trading range, selling into strength, manufacturing support, and managing perceptions, until his work is complete. Then, after a final deceptive trap, he removes his support and allows the market, now heavy in the hands of the public, to collapse under its own weight. Your goal as a thinking professional trader is to understand this process so intimately that you can never again become a victim of it. Your goal is to learn to recognize the signs of euphoria, not as an invitation to a party, but as a warning that the party is about to end. Your goal is to protect your capital by exiting alongside the smart money, and to never ever again serve as the exit liquidity for someone else's perfect trade.